How do you overcome impatience? Well, it stems from a lack of experience. Experience in the sense that, number one, you have to know how these markets can hurt you. Obviously, it goes without saying that if you're wrong, you lose money. But you have to have experience knowing who you are. That's the first step. And all of the things I put you through, that's the first thing you're trying to discover. Who you are as a person. What makes you tick? What makes you think? What makes you want to take a trade? What's occurring in your mind at a time when you think that there's something going on in that chart? That's the biggest hurdle. Every single person that's ever going to amount to anything as a trader, profitable, consistently profitable, wildly profitable, the central tenet to all of them is they know themselves very well. And they know how they will derail themselves. It wasn't until I understood how I could unravel myself. Doesn't matter how many gizmos and things I can see in price action. If I'm miswired, if I'm off center, like I feel now, which is why I'm doing these. If I do this, it kind of allows me to discharge instead of going into the market and trade. Yeah, I made pretty good yesterday trading, but I wish I wouldn't have done it. I'll say that again. I wish I would not have traded yesterday. I broke a rule yesterday. And while I left with something, the win doesn't outweigh the fact that I know that I did not follow my rules. And I feel guilty. I feel like my hands are dirty. One of the weirdest things you're going to encounter is you'll think when the market's being held in consolidation, you feel like you're going to know how it's going to break out. And you start anticipating. Yeah, I think it's going to go up there. How do you know that? How do you know that? You just started. Do you have a journal, a track record of you trading with that idea, that insight, and it works? Or are you just thinking impulsively about what you may expect in price or what you would like to see, and you're projecting your will on price? If the market runs real quick, as soon as you sit down in front of the charts and you're expecting something to happen, or you join a community, or you're in a Discord channel, or you're among a number of other people that are sharing openly what their opinions are about the marketplace or one particular market, and you're watching it, if you're brand new, you're actually conditioning yourself to be responsive to a collective mindset that may not be all that in tune with what really is going to happen in the marketplace. In layman's terms, you're hanging around in a mob and you're thinking only based on what the collective mob mentality is going to say about that market. And if you've never paid attention to it, just watch and see how the ones that come out openly and say, yeah, I think the market's going to go up. I think the market's going to go down. That's why I love going into the handful of live streamers I like watching. And this is the only reason why I like watching it. I want to see what their audience thinks about the marketplace. I want to see how the sentiment shifts in their chat window if they make it available. Or I want to hear how they themselves, the presenters, think. If they start talking very dogmatic about how they know it's going to go up there, it's just going to have to do this. And if I see a setup, I know I got a 99% likelihood I'm going to make money there. I'm not watching other YouTubers to learn anything. I want to see what a retail trader's mindset is about the market at the very time I'm anticipating my algorithm to spool a specific direction. The absolute worst thing you could ever do to stifle your proper development is to be part of a group of people that are going to inspire you to do things many times after the fact. You're looking for a hand-holding experience versus how I'm teaching you. You're going to walk alone. But the next thing is impulsiveness. If you're an impulsive person, what you're doing is you're showing signs that you have a lack of knowledge of price. So the normal progression is, while a trader starts this journey, the thing they overlook first and foremost is they themselves. once they get a better grip on who they are as a trader, and they feel like they can conquer themselves in the personal sense, that doesn't mean that they have conquered the uncertainty about what price does generally. What separates me and our community from most others is when we talk about price, when I'm referring to price, I speak from a position of authority, authorship. This is what my algorithm's going to do. This is what it's been coded to do. This is what it's going to deliver. Just watch. Impulsiveness stems from the lack of knowledge of price. You have to understand the central tenets of price delivery. That takes a lot of time. My algorithm delivers on time and price. It will not do anything but, unless manual intervention steps in. Putting that aside, you have to know what the normal delivery of price is. When does the market usually have a spooling event? That means where it starts to run in one direction. It doesn't need to be fast. It doesn't always have to be a low resistance liquidity run where it's here 1 minute and then a couple minutes later, it's already up 50 handles. It just means it starts to go into a specific buy or sell program. That's not a buy and sell model. A buy program is when price or institutional order flow just starts delivering higher prices. It doesn't matter how many people are buying it. It has absolutely no fucking reason why price is going up. It's being offered continuously. That's a buy program. It's going to just keep offering at a higher price. Keep higher, higher. And it just keeps doing that. When markets move up, they're in a buy program. But you have to learn what these markets do through price delivery. And if you do that, you remove impulsiveness. What is impulsiveness? You're watching price and you're simply waiting for something to happen in price and it starts running higher. What's everyone going to do? Oh, I'm buying. Oh, it's going up. Everybody will find their voice then and say, it's going higher. Of course it is. It's going off 30 handles. It's running. And then you feel like, I got to get on. I got to get on that. And what do? Buy it. Because it might keep going up to where? I don't fucking know, but it's going to go up because look what it's doing right now. That's impulsiveness. But the only way you combat that and you keep it at bay and you conquer it is to learn about price delivery. That means you're not even back testing. You're just studying what price is likely to do most times. In certain instances, in certain circumstances, the market will create market reversals. It'll create continuations. It'll create range-bound opportunities. Your impulsiveness is conquered by the study of general price action and understanding what's available in terms of how markets move. It moves from consolidations to expansions to reversals. Knowing that ebb and flow, how it does it, and then applying it from a higher time frame, monthly, weekly, daily, 4 hour, 1 hour, 15, or whatever time frame you want to use, you navigate with that price delivery continuum from higher time frame to lower time frame. And even if a move has already started on the daily chart and it's ran several hundred handles or whatever on a big day, you know that you're not going to be impulsive the next morning. I got to go in there and chase that. It's going to keep going down, which is the first rule I told you. On a large range day, what do? Lower our expectations on the morning session. That doesn't mean that the market can't run. It doesn't mean that you can't take a trade. It just means that you, as a developing student, you, as a new trader in the making, you're not there yet. Don't have a hard opinion immediately the next morning after a large range day. Wait, that's amateur hour. Everybody is going to be thinking the same thing. It should keep going lower, and they're going to be waiting for that. But what happens if it doesn't? Perfect. It starts trading up into the previous day's range if it went down. And as long as it doesn't go across half of that previous day's range, the highest probability short is going to exist in the lower half of the previous day's range. And if it can't get 1/4 into it from its low, and it starts giving you a breakdown in market structure on lower time frames, you have all of the hand that needs to be shown to you at the poker table that this is what the market's about to do. Then it will go lower. It's going in to price in a short-term premium. Then you wait for a shift in market structure. which is not a break in structure. It's a shift in market structure. When there's an established bias or an order flow or a sell program that's entered into the marketplace and it's been going lower, when it moves against that, all you're doing is building a short-term premium. And then you're going to wait for the market to shift back into a sell program. It's not a break in market structure. A shift in market structure is a continuation of the existing narrative and or buy or sell program. That's it. That's the definition. The next tenet is fear. Fear is the lack of journaled case studies. You're fearful that this isn't going to work. How do you get over it? By backtesting and journaling case studies of what you are expected to do when you're trading live, what you're trying to see in price action. And that way you see how many times it works. How many times did it fail? How many times did it go into a certain measure of drawdown? How many handles did it go against you before it started moving in your favor? How long did it take from your trade entry using the worst case entry point, not the best, and then when it got to your objective, whatever some liquidity would be or inefficiency it would be trading to? Your target is always going to be the opposing inefficiency. That means a fair value gap below. If you're short, you're looking for an inefficiency to target, or you're looking for a low or relative equal lows. So you're looking for sell side or a buy side imbalance, sell side inefficiency. That's your two targets when you're shorting. How fucking hard is that? That's not complicated. Fear is easily conquered. Easily conquered. Once you go through the process of collecting the resources and case studies, where it worked in the past. And what you're doing is you're training your brain to see these examples. By retention, doing it over and over and over again, you're giving yourself pseudo experience. That means that you're seeing something that's already happened, but you're putting annotations to it in a journal, and you're really placing a lot of significance on that. Your journal is your fucking secret weapon. It's the greatest fucking trading book you're ever going to read, and you're writing it yourself. You can't make it more intimate than that. It's your experiences, your study time, your focus, where you can be honest with yourself and not be embarrassed about, you maybe expected something else that day. And you can say it sweetly in annotations without being negative, because your subconscious is going to retain that. Your subconscious doesn't remember things vaguely. It doesn't do that. It records things that are heightened, whether it be euphoric or fearful, extremely pleasant or painful, inspirational, desperation. There's no middle ground in your subconscious. Everything is reactive by black and white, good and bad. It's just the way it is. So you have to take that into account when you're training your brain. And this is a very integral part to learning how to do this. You have to condition yourself. That's why you can't do it in a very short span of time. Your brain is extremely complex. It's extremely powerful. And if you feed it the wrong things, it will scare the living shit out of you, and you'll never learn how to do this. Stop forcing it. Stop rushing it. It has to be meditative. It has to be something that you do as a daily ritual, even on weekends. You have to feed your mind constructive, positive learning case studies where you see these things happening in the past. You're fearful that it's not going to work for you because you don't know what the fuck you're doing. That's all. That's all it is. The way you conquer your fear about trading is you condition yourself to find the atmosphere, the conditions, the profile in the marketplace. Whatever that is for you. For some of you, it might be as simple as, I want to do a classic I.C.T. buy day, where you're waiting for the opening. You want to wait for a Judas swing to drop down, maybe going into take sell side liquidity out on a lower time frame, or trade into a buy side imbalance, sell side efficiency, fair value gap. And then you're buying that with the expectation you're going to hold it for the entire range, and you'll get out in the last hour of trading. And you're going to wait for instances where that can manifest itself in price. It won't be every day, but you're okay with that because you're not out there trying to impress everybody that's day trading as you being an everyday trader. which rolls us into greed. Greed stems from the lack of trust in yourself and or your model. Wait a minute, how can that be? If you're greedy and you're saying that I'm greedy because I have a lack of trust in myself and or my model, how can I be greedy? Because you want a lottery mindset. You think that this stuff works, yes. But it just might be the day that you go in there and try to do it, it might cause you losing money. It may cause you losing peace of mind. It may cause self-doubt. And you may blow the account. And you'll hear people out there that never show you that they make money. They'll tell you, you got to push your edge. When you're making money, you got to push your edge. Keep going in. Keep going. No. I teach plateaus. So when you're climbing your equity curve and you're getting in, you're trying to find profitability and consistently profitable, each day, in the beginning, you think, I want to make this much money every single day, this percentage every